Welcome back to another Meet Kevin Report. We're on episode 67. That means in 2 days we will be on episode 69, which will also be April 1st. It's almost like somebody planned that or just had incredibly dumb luck. Who knows? But, well, maybe I do. But what I can tell you is that the 10-year Treasury right now is sitting pretty stable at 3.55. We sit around here, it keeps mortgage rates for homes somewhere around 6.3 to 6.6% for a 740 plus credit score. Still adds some pressure to real estate, but what if people get used to it? Some folks are saying is once people get used to these higher rates and have the expectation that they might be able to refinance in the future, maybe they'll just keep buying. Of course, that assumes no surge in inventory for housing. We'll see what happens. Oil prices up about 0.7% today, both and over the last couple of days, they've been up about 6%. So something to keep an eye on. Oil prices rising up again. Kind of some of that banking, excuse me, some of that banking fear went away and escaped to the oil market pretty soon after the banking crisis has kind of settled down. Well, I don't know why I could have no sneezes all morning long and then within 30 seconds of recording all of a sudden sneezes, but I guess that's just the way it planned. The Chinese are after me again. But anyway, pre-market is green, and we've got some catalysts coming up as well as many other subjects to cover. I'd like to start with a pretty important one for the Fed tomorrow. So we'll start there. And then we'll dive into some of the other beautiful, sexy topics we got to cover. So keep in mind that today we will be getting jobless claims as well. We'll be covering those in this video when they come out in about 1 hour. All right, let's get into the Fed's preferred inflation gauge, known as the PCE, and the PCE projections. We'll go through all of those and implications for the market. Well, the PCE comes out at 5:30 a.m. Pacific time on March 31st, which also happens to be the deadline for investing in the House Act. But this is a very key measure for the Federal Reserve. And I want to give you the projections so that way you're prepared and you've got your expectations potentially aligned with what the heck economists think, unless, of course, you want to take the contrarian point of view by going with the over or the under. So, first, the PCE is the Fed's preferred inflation gauge known as personal consumption expenditures. It's an index measured very similarly to CPI. One core difference, though, is that housing is actually a lower weight in the PCE. In PCE, housing only comes in at around 25%, whereas in CPI, you're closer to 34%. Now, that's actually quite potentially important because in the last CPI reports, the last two, we started using new weights, slightly higher weights for housing. And housing services have still been hot. They've been coming in hot, to the point where some are saying one of the only reasons we're still getting hot inflationary data is, yes, some part because of the stickiness of some of the services, though that may actually be going away thanks to tighter credit standards. Really a topic for a different video, but quick little spoiler alert, there's a lot of talks that as banks tighten lending, guess who doesn't open up restaurants anymore or certain businesses anymore? I guess I kind of spoiled that one. Restaurant owners or hotel owners or service industry owners potentially stop opening up new facilities, which then it makes you wonder, does that actually potentially increase inflation because you have less restaurants? Or does it actually mean there's less pressure on wage earners in retail and hospitality? At the same time, the economy is a little teeterish, maybe putting less pricing power into the hands of individuals, meaning potentially less inflationary impetus for the service sector. Either way, any kind of credit tightening is not what we're expecting to see in this next report. And that's because this next report is going to talk about February's data. And I'll give you the projections in just a moment, but it's just important to note that they have less of a housing weight than CPI, and it comes out tomorrow. The stock market is very likely to move based off the numbers that we see in this particular report. So, tomorrow, the personal consumption numbers are expected from a prior release of 0.6, which was the hot January number. We are expecting to get a 0.2%, which is actually very good. If we could get a 0.2% on the release, I think that's phenomenal. The reason we want to see a number like this is because the number would actually, on an annualized basis, be somewhat in line with 2% inflation. A 0.2% read is about 2.4%, and the Fed could easily, in my opinion, argue that 0.2 is well within the bounds of averaging 2% inflation. So that could be a good number to hit. If it comes in less than 0.2, I would expect even more enthusiasm for the stock market right now. Technically, the NASDAQ yesterday entered into a bull market. Now, this was pretty surprising to me, but it's true. The NASDAQ is up about 20.4% from bottoming out in October, and technically now the NASDAQ is back into bull market territory. This is quite remarkable. This is actually leading Bloomberg to put together multiple different stories on how it's basically buy the dippers going back into action and buying. And I think that activity could actually be accelerated by a weak PCE, producer price, or sorry, not producer price, that's PPI I'm thinking of, by a weak personal consumption expenditures read. I mean, take a look at this story here from Bloomberg. This one right here, wild stock market reversals put dip buyers on a historic or a pace for historic year. All right, let's take a look at. And then, of course, we have some more projections to get into for the survey tomorrow. But anyway, look at this. In the 2023 stock market, when one group of companies fall out of favor, another usually is ready to take its place. This is called the cyclical transition sort of stocks. Generally, you go into a recession, people go defensives. They go to utilities and healthcare and staples. And then when the recession bottoms out, people go to growth because they think growth will lead you out. And kind of get these sort of moves around. When there's war, people flee into the military-industrial complex, right? These are very, very typical kind of moves. But anyway, the latest winner is the firms with the riskiest credit. That's actually kind of scary. Poised for their best week since January versus their sturdier balance sheet counterparts. The outperformance is happening as credit markets stresses ease, helping push the S&P 500 up for 4 out of the last 5 days. The sudden popularity of firms with dicey credit is part of a large pattern in equities this year where harried traders reliably find new vehicles to express bullish views. Now, personally, I just want to be clear in case I haven't already been, I'm a big fan of looking for companies with high free cash flow, which is operating cash flow minus capital expenditures, and high net income. I like both of those, okay? And if they could be in growth and I could get all three of those and some pricing power, that's awesome. But Bloomberg's talking about 2023 is shaping up to be the second best year for the dip buying strategy. How wild is that? A Gloomberg, that's a good one. A Goldman Sachs group basket of companies with weak balance sheets advanced for a fourth straight session, extending its week up 3.3% compared to a weekly return of about 1% for the Goldman basket of companies with sturdier finances. Weak areas of the market may be seeing short covering or momentum trading that is looking for quick gains. Now, personally, I think that's a little risky. It's a little speculative, so it's okay if you're trading these sorts of things, but I'm a little bit more of a fan of an in and out if you're going to be playing with potentially more highly leveraged companies. But it's kind of wild to think we're back into a technical bull market territory. Crazy. All right. So headline, 0.2 versus 0.6 from last time. Then we get personal spending. Suspending. Oh, it's too early. Personal spending in January came in at a gain of 1.8%. We are now projecting 0.3%. Okay, reasonable. Remember what the stock market is going to try to balance right now. We have a little bit of, I like to call it the teeter-totter. So if I kind of draw a little triangle here, and this is our market that we're trying to balance, really what we're trying to balance right now on one side is sort of our regular inflation risk. But then on the other side, we're also trying to balance financial stability and recession. Right. So on the right side, you kind of have your banking crisis, and on the left side, you have your inflation risk. And so we're kind of doing this right now because either of these being bad would mean the party's officially over. Although I think the party's been kind of dead for like the last year, but beyond that. All right. So real personal spending Inflation adjusted expected to come in at 0.1% versus 1.1. Then we get the PCE deflators numbers. Now we're actually getting into PCE. So we get retail spends or personal income and expenditures. Then we get the actual inflation version of the number. PCE deflator month over month expected to be 0.3%. It's a little higher than that sort of average 2%, right? 3.6%. Then we get and that's different from sort of personal incomes, even though we want those to also be somewhat close to 2%, because the idea is if personal incomes are close to 2%, then inflation might be close to 2%. Personal incomes really give you a measure of the wage price spiral, and that's again expected to be 0.2%. The actual PCE deflator month over month is expected to be 0.3%, a little bit hotter there, probably because of that housing and sticky services side. And then the year over year is expected to be 4.7%. 4.7 is the same read we got last time. That is the, I went ahead here. Let me read this correctly here. PCE deflator month over month, 0.3%. PCE deflator year over year, 5.1. PCE core year over year, 4.7. And PCE core deflator month over month, 0.4. All of those measures are down from the January read. The most important here probably being that month over month, 0.3 versus the 0.6 from last time, with the exception of a year over year core matching 4.7. That report will come out tomorrow at 5:30 a.m. Pacific time, 8:30 Eastern. We'll also be getting the University of Michigan consumer sentiment. Now, we'll have some talking about sentiment to do today, and there's some concerns that sentiment could actually fall once we're actually in an official recession. But what's important from sentiment, in my opinion, is that we're going to keep those inflation expectations stable. U of M 1 year expected to be stable at 3.8, and 5 to 10 year expected to be stable at 2.8 for inflation. So that's fantastic. Now, that month over month deflator number, that's basically your CPI month over month read, very similar to that. Again, expected to come in at 0.3%, and that'll come out tomorrow. We've got for tomorrow, I want to give you kind of the skew on this. It looks like we've got 44 estimates. The high estimate is 0.5. The low estimate is 0.3. And the average estimate is 0.35. So it seems like there's a real skew. Almost everybody on this chart is sitting under 0.45. Nobody's under 0.25. So what does that tell us? Well, it tells us if the number, if PCE month over month comes in at 0.2 tomorrow, that would be pretty dang bullish, because really nobody is estimating that we're going to be at anything under 0.25. So if we get a 0.2 on PCE deflator month over month, good sign. It's our rocket ship on the way to Mars. Then if we get any kind of number above probably 0.5, like 0.5 or up, that would be really bad news. My expectation is that's going to be the most important number, specifically because those month over month numbers are really useful because they kind of ignore all of the last year stuff, and they just tell us what's happening right now. So I personally like this. That's not to say that the year over year number doesn't need to come down as well, but those are going to be some important data points coming out tomorrow. And especially since at the same time as these data points are expected to come out, we're obviously in this environment where we're kind of starting to build the Nike swoosh. Now, I'm really excited about that. Do keep in mind that when we talk about the swoosh, I generally like to show QQQ. But if you're going to invest in the NASDAQ, I'm actually a bigger fan of you using QQQM. So just add an M to that ticker symbol. The reason you want to do that is the fees are substantially lower, and it's basically the same index. It's actually provided by the same company. And they just basically, they do all their marketing for QQQ and not for QQQM. So the price sensitive people can go over to QQQM while they could still milk lots of profit off of the QQQ investors. Anyway, something to keep an eye on. Just like the programs on Building Your Wealth, link down below, and the amazing opportunity for you to get life insurance in as little as 5 minutes, linked down below, right next to the get 12 free stocks with this very platform right here. So if you like what you see on this platform, 12 free stocks, linked down below. I'm supposed to put up one of these buttons. I think if I push, is it this button? One of these, there we go. No, that doesn't work. One of these buttons tells you it's a paid promotion. I can't figure it out. Oh, that one still says paid promotion. It wasn't 6. Was it 7? It wasn't 7. There it is. Button number 8. All right, anyway. So where were we? I gotta figure that stuff out. So what we got over here? I really think this is the start of it. I really hope we don't drop down again, right? I mean, if we drop, like, volatility, totally to be expected. I expect this. But if we break the lows over here, the Nike swoosh is dead, which would be a problem because I've kind of been betting on the Nike swoosh. But at least I'm making a bet. So I believe that even though this was representative of a year, I believe that the handle over here is going to be 10 years long. So, strong bet. But I think in hindsight, this is going to look like a joke. Look at, like, remember when the NASDAQ was running for like 2 years straight over here? Look at this, like, 2-year run over here. This is kind of an example of a Nike swoosh over here, except it just uses the shorter COVID pandemic to show you the left side of it. Look at that. Down, straight up, basically. Yeah, was there a little bit of, I mean, this is why buy the dip worked so well, because you could buy the dip and just immediately get rewarded afterwards. So that's why we had such a buy the dip area over here. And this was long. I mean, that was from March of 2020 to December of 2021. I mean, that's almost 2 years. That's wild. Of course, now we're in a substantially larger downtrend. And hopefully that's the beginning of the swoosh recovery over here. So far, it actually has been tested, I think, a lot better than some of these other drops. I mean, consider this. That was not even really a recovery over here at the beginning of January last year. We look over here at this brief recovery in March. It brought us to new lows right afterwards. Brief recovery here in August brought us to new lows. And then really it's been since about October, November, right around when I launched my ETF. That's interesting. We launched the ETF like the 30th, like somewhere over here, like the 30th of November. Learn more by going to meetkevin.com. But anyway, I really hope this is the bottom. And so we'll see. And what's different here is the last time we had this sort of red bear cycle here briefly, we didn't actually break new lows. When in the past, when we get our next bear cycle or our next red bear cycle after our green up cycle, we tend to break to a new low. We didn't do that. So in my opinion, that's reiterating this sort of channel of the Nike swoosh, which I think rides this line over here. So I think it'll probably be until July, based on this right here, before we actually break up to the next Fibonacci retracement line. No guarantees. Who knows? Maybe we'll break it sooner. But if we break it sooner, we'll probably fall back to it in honor of that Nike swoosh. Like I say, I think we're going to be in a little bit of a volatile recovery up. So we'll see. So that's a little bit of my thesis on the Nike swoosh and the important catalyst to pay attention to tomorrow. Of course, I'll be streaming it live tomorrow, so make sure you come to your Meet Kevin report tomorrow at 5:30 Pacific, and I'll cover the news the second it drops. My goal is always to beat CNBC. If I can beat CNBC, I win. And so with that said, make sure to check out the programs on Building Your Wealth link down below. Yesterday, we talked about shorts. We also did fundamental analysis, but we also talked modeled shorts. So if you want to see that for whatever reason, check out the programs on Building Your Wealth link down below. See, you never know what you're going to get. You just don't know what you're going to get. But usually it's fundamental analysis. We talk about the size of PP. And yeah, check that out. Link down below. And make sure you remember that house hack deadline. All right, now we got to talk about artificial intelligence. AI has been a really interesting topic lately. And so we're going to talk about AI, some chip stocks that could be related plays to AI, and some of the wilderness that's happening in terms of reporting on AI. All right. Let's get that ready here. Let me just take a second. Generative AI. We got this. All right. Very cool. Now we got to talk about artificial intelligence, generative AI, what it could potentially do to the jobs market. Is it an inflationary impetus? Is it disinflationary? What companies might benefit? And what are some fears that are circulating? Because I'll tell you, Elon Musk, along with 1,100 engineers yesterday, signed an open letter calling for a 6-month pause on any kind of artificial intelligence that is stronger than Chat GPT 4 level strength. Now, I tweeted about this. Of course, I feel like when I tweet logic, it's not as sort of like viral as if you tweet something that's more emotion based. But I do it anyway because I like to share what I think is logical input. And hopefully you like following for that. And so I shared this. I said 1,100 engineers and Elon Musk signed an open letter demanding any artificial intelligence development stronger than ChatGPT 4 pause for 6 months. Based on this scientific game theory I just drew, it looks like your choices as a company are pause and have a 50% chance of dying, or don't pause and have a 50% likelihood of dying. Looks like you're screwed either way. In other words, in a game theory example, in my opinion, it makes absolutely zero sense for any company to actually pause their artificial intelligence research. Because think about it. If both companies pause, what do you get? Well, you get a stagnation, right? Defined by PP. Both companies pause, you get a stagnation. Everybody loses. The potential benefit is, hey, maybe we could regulate AI and the world doesn't end, right? Because the idea, if both companies or all companies don't pause, then maybe the world ends because robots and AI take over the world. All right, whatever. That's sort of this extreme argument right now. But the more likelihood is that some companies pause and some don't. And in that case, the companies that don't pause win. The companies that do pause die. So basically, by pausing, you're signing up for killing your company. And if both companies don't pause, you're basically signing up for killing your companies. So the best answer is everybody pauses, but the likelihood of everybody doing that is basically zero. It's a classic prisoner's dilemma scenario. So, without going into the details of exactly what that is, I think the bottom line is simple. When it comes to Elon Musk's letter, it's a nice way to suggest, hey, can everybody please put their swords down for a moment while everybody else catches up? And in public, people are going to be like, yeah, sounds like a great idea. And in private, everybody's going to be like, keep going, man, keep going. Come on, man. The world don't work like that. It's way too competitive. Way too competitive. Hell, I'll say it. If everybody else pauses, I'll jump in and I'll start developing. I'm not a developer. Although I have developers that work with me. So maybe I'm one of those not pausers. Ooh. But anyway, we got to look at this Goldman Sachs piece. Let's take a look at this. All right. What do we got here? Generative AI, laying out the investment framework. We're going to be going into some specific stocks as well. But listen to this. Generative AI further unlocks value as it extends the utility created by AI or software, providing new tools for enhancing end user productivity. Now, I have to say, I've been playing with generative AI. And one of the things about AI is that we've regularly been saying, oh, well, AI is not going to remove like creatives, right? There's no way artificial intelligence is going to affect creative people. So as long as you're creative, you're good, right? I don't know about that. Just because, I mean, you can now feed into an AI, hey, AI, design me an app. And even though some of these AIs, they're not really good about putting text on yet, in terms of actually giving you inspiration for layouts, look at this. I put into an AI generator, give me a real estate investing app. And this is what it came up with. I have to say, for 30 seconds of work, it's kind of cool. It gives you inspiration for buttons and colors and gradients and style. In the future, we'll be able to just hit export and you'll get the code for it. And then you can adjust, the text and all the little funky miscellaneous stuff. Generative AI is pretty impressive. I mean, to the point where Max is like, Dad, can you draw a ball with eyes coming out of a box and glasses, and like a little character? And the AI gave me 4 different choices, and I was blown away. I mean, look at this. Within like 30 seconds, look what I get. This is insane. This is really good. I mean, like, I can't draw that in 30 seconds. And that looks phenomenal. I mean, how long would it take a creative to actually design this stuff? 2 hours, 3 hours? I don't know. Even if somebody's really good, an hour? It took the software 30 seconds. And if you can now export all of these elements in the future to Photoshop and then or whatever, some kind of software, After Effects, whatever, and start animating this or playing with this, boy, I mean, I thought creatives would be safe from AI. Generative AI is pretty dang impressive. Everybody's at risk. But anyway, how do we make money off of it? Well, that's why we're talking about Goldman Sachs. So generative AI is about generating stuff like we just did. We estimate that generative AI software has a total addressable market of $150 billion versus the total software industry of $685 billion. No, it's not Stable Diffusion. It's my secret. But listen to that. That is 150. That's 22% of the entire total addressable market for software could be literally generative AI. But you know what the beautiful thing about generative AI is it isn't even processing on my computer. I did that on an iPhone. Why did I do it on an iPhone? Because it didn't use my iPhone's graphics cards. It used a server somewhere to do all the artificial intelligence work and then beam over an end product to me. People made fun of me for, in my active ETF, you could learn more about by going to meetkevin.com. People made fun of me. They're like, oh, Kevin, you're too heavy on chips. And I'm like, are you kidding me? Have you ever in your life used a backbone controller for a cell phone? Have you ever used generative AI? And do you understand where the video processing is done? Maybe not. Well, I'll explain. Not on your phone. So this right here is a backbone controller. It's pretty cool. You can put your phone into it. And look, I'm not a game review channel over here, but the point is just to say that this basically turns into a gaming controller, just like this. And it's a backbone, little controller or whatever it is over here. And the cool thing about this is I don't actually use the processors for gaming in my phone. I can stream them through xbox.com and basically have a virtual gaming machine that I can stream through on here. Now, yeah, you should have a low latency internet connection, but fortunately I got fiber over here, so it works very well. But I basically have an Xbox in my pocket, and when I travel, if I want to do anything, I got a whole Xbox with all the games I could want in my pocket. Now, I rarely use it. I generally give it to the kids. But the point is, I just gave you a few examples here of how generative AI could be really incredible. Not only can you generate characters and then animate them for video games, or you could generate app ideas, but all of this is being processed not by your devices, but by other devices. That's a huge boon, in my opinion, to the chips industry, because who's processing it? Data centers and servers. Anyway, Goldman Sachs has some ideas in terms of how some companies could benefit, and so let's take a look at that. All right, so we raise, as a result of this piece here, we raise our price targets: $10 on Microsoft, Salesforce $5, Adobe $5. Ooh, it's one of the ones I have exposure to incorporate higher outer year estimates to reflect our conviction in the success/adoption of newly launched generative AI projects. It's pretty exciting. Copilot, by the way, is a fantastic tool for basically helping programmers code a lot faster. Additionally, we highlight companies like Intel, Google, Amazon, NVIDIA, and Meta as the companies best positioned to succeed in the new AI-driven paradigm. This is pretty exciting. So I want to talk about this some more, and we'll go into some detail here, as well as some potential risk factors. We'll go into detail specifically on these companies. But take a look at how this is starting to also change the media narrative. So look at this. Generative AI. This was on the front page of the Wall Street Journal today. Generative AI is already changing white collar work as we know it. And they basically have a whole piece talking about how people are like, oh gosh, we are actually going to see job loss from this. And they're talking about how companies from Walmart to ZipRecruiter and Yelp are already kind of basically plotting how to use AI to take over the world. Quite frankly, I think at some point in the future, I think this is just like a very realistic point of view. I think at some point in the future, using AI, and it could be now, using AI versus not using AI will be as extreme as using a computer versus not using a computer. Like, let me use a more relatable example. Well, at least to my generation. Uh, if somebody's like, hey, I'm going to mail you something or I'm going to fax you something, and you're like, what the F? Why don't you just email it? Okay. That's kind of the level of difference that I project for AI. And I think that every company in the future will use AI. It will be as simple as saying, we use email in the future. Like, of course, you're going to use AI. Then it's just going to come down to which companies are going to be best positioned to use that most effectively. At my real estate startup, we're very excited about using it. It's still too early for us to let it make decisions for us. Way too early for that. But we could definitely use it to ping us of certain ideas or trends or deals. So we really like that. That's already working. It's pretty incredible. Anyway, let's keep going. So I've actually bought deals from my AI already. Not for my real estate startup, but for myself. A couple years ago, I was using a software. I go through the software. I'm like, oh, damn, that is a really good deal. It is. So, like, it still takes the human element today, but the potential is like, anyway. So what do we got over here? Monetization in enterprise software and cloud computing. Just as cloud hyperscalers like AWS, Azure, and Google Cloud Platform commercialized cloud infrastructure and platforms, which in turn accelerated the growth of software services businesses, we believe that OpenAI's ChatGPT will drive adoption of generative AI across software enterprises. In this report, we further explore the opportunities for AI to be integrated into the tech stacks of the future by drawing an analogy between cloud computing and an IT stack layered with AI. AI is expected to drive significant productivity gains for the economy. They estimate potentially $7 trillion of global economic growth over a 10-year period, with productivity growing 1.5 percentage points faster annually over the same period. In other words, AI could potentially expand our GDP substantially faster than anybody is expecting today. Now, this is actually an argument that the great Cathie Wood tells us. In fact, when I was at dinner with Cathie Wood, she specifically wanted to drill home, Kevin, nobody knows what's coming. And it's not like it's a big secret. She talks about this herself as well. But the fact that it came up during dinner, it just showed me her passion for this belief. And we're seeing more and more of this. It's really, really incredible. So we believe generative AI can contribute a TAM of 150 billion to the global software stack. I agree. It's also, there's an idea here that maybe, just maybe, we can outgrow China if we can have an edge on AI versus allowing China to sort of catch up to our GDP, so to speak, right? And that's really a suggestion of maybe the US being able to insulate itself. Generative AI tools have far-reaching implications. Generative AI is enabling sales and marketing teams to generate new content, DevOps engines to write faster code or code faster, knowledge workers to improve day-to-day office efficiency, and scientists to develop drugs for rare diseases and much more. There are a lot of actually really cool implications with artificial intelligence for the healthcare industry, being able to even just diagnose patient ailments in a way that doctors really haven't been is phenomenal. Sometimes it takes going to a doctor 5, 6, 7 different times to try to get a conclusion to a certain ailment. Whereas if an AI was able to maybe just suggest a solution, there could potentially be faster medical care or more urgent care in the case of indicators that may say, hey, there could be something more malignant happening. So this is really good for healthcare as well. And keep this in mind too. ChatGPT is already reportedly replacing workers. I reported on this a few weeks ago, but I think it's a perfect place to reiterate this before we go into a little bit more of that analysis from Goldman Sachs on which companies and why. Companies that reported using ChatGPT to resume builder said they used ChatGPT 66%. Or 60%, 6% of the respondents said they used it for writing code, 58% for copywriting content, 57% for customer support, 77% for writing job descriptions. Actually, for like listing descriptions on the multiple listing service for Airbnb. Well, Airbnbs aren't on there, but for like real estate listings or Airbnb itself, car rental descriptions, job descriptions. Basically, copywriters to some extent are either being aided by ChatGPT or just replaced at some point in the future. Kind of scary time to be a copywriter, because essentially you could take a whole document, throw it into an artificial intelligence program, and go look for, run-on sentences, wordy sentences, not just spelling and grammar, but actually like more logic-based problems. Hey, where does this not make sense? Where does the sentiment stray? And these are some pretty incredible prompts you can ask AI these days, and they're already doing a phenomenal job. Out of 500 companies interviewed by Resume Builder, 250 companies, half of them, said that ChatGPT has already replaced workers at the company. How wild is that? This comes at the same time as multiple different companies and partnerships are being expanded upon. You've got the you've got Google partnerships and Google Duplex. You've got Bard over at Microsoft. Some really incredible expansions. And ChatGPT 4 is substantially more powerful than ChatGPT 3.5 already. Let's keep going here. So generative AI, we talked about that. We expect incumbents, a new wave of innovation across the incumbents. Now, this is such a really incredible argument. Usually one of the explanations or reasons people say that, AI, or rather mega caps are a bad investment, is because they say mega caps used to be innovative, and that's why they were disruptive and grew as much as they did. But now they're not innovative anymore. In other words, the innovation is dead. Well, AI is being argued to potentially being capable of allowing some of the existing massive companies like Microsoft, Alphabet, NVIDIA, Amazon, Salesforce, Meta, Intuit, and Adobe to lead the industry in sort of a new wave of innovation. I think before I may have mentioned Intel. I suppose I meant to say Intuit. But anyway, that's interesting. So then there, and mostly because there's a lot of talk about this innovation slowdown in America. And so that's very interesting. So this expands the opportunity for more seamless upsells, cross promotions. Cloud providers we expect to use generative AI will drive demand for compute. Compute is great for, again, the chips manufacturing sector. See, we've got a little note here about how chips manufacturing companies sell the pickaxes, while software have to find the gold. Let's take a look at their talk about Microsoft. They think Microsoft has this large enhancement to really their Edge browser and their Bing search experience by including their Bard AI into search results. They see that as a pretty good driver of potentially Microsoft Edge software usage, their browser, which could lead to more potentially advertising sales for Microsoft. It's actually really interesting. I was reading a story just yesterday about how ad sales, despite the crazy economy, are expecting to pick up. Actually, it's worth looking at that because it's quite related here. Oh, yeah, here it is. U.S. ad sale spending still expected to grow in 2023 despite, quote, stressful economic signals. Now, that's important for companies that I like exposure to as well, like Trade Desk. I like to hear that there's still growth in advertising. I've actually fled to Trade Desk because I think they're one of the most pure play advertisers that's actually in a very growing niche within advertising. But if the entire advertising space still grows, that's even more phenomenal. So I saved this article. I was starting to read it a bit yesterday. Let's look at this. A major ad forecaster said advertising is still expected to grow in 2023 despite mixed economic signals, a resiliency that industry pros say would have been unlikely during earlier periods of turbulence. Media owners And this is actually great for Microsoft and Google. I actually stopped investing in Google for a while, and I have many reasons for that. We've been talking about that a lot in the course member live streams. But now I'm starting to wonder, hey, is there potential? Has Google potentially hit its Nike swoosh bottom? I mean, just to compare to the Nike swoosh for a moment, there's Google. You're still kind of bobbing along in that lower region here, but we've definitely inflected off the low lows. So maybe worth revisiting in our course member live stream today. But let's look at ads here. Media owners' U.S. ad revenues are expected to grow 3.4% to $326 billion this year, according to a quarterly forecast from Magna, a media intelligence and investment firm. Interesting. That's actually surprising. That's slightly down from their December estimate, but the fact that it's still positive for the overall media industry is actually really incredible. 3.4% for the entire industry. That's great. The firm expects little or no growth in the first half of the year, followed by a recovery in the second half as the economy becomes more stable. Wow. I mean, this flies in the face of this idea that, Q3, Q4 recession. This ad buying or this ad analytics firm is actually suggesting, no, things will actually be better in the second half. Now, that does sort of get reiterated by a lot of company earnings calls who say they expect their margins to be stronger in the second half as they finally have raised prices. They're not raising prices anymore now, but then they've laid off excess workers and they're becoming a little bit more efficient. That's actually a very interesting argument that the second half may not be as scary as people keep forecasting that it may be. And that agrees with my Nike swoosh thesis, so maybe I'm a bit biased there. Keep in mind, by the way, my goal now is to send probably with starting this week or next week, sending daily buy-sell alerts for some trades that I'm doing. A few days ago, we had a really cool sell-put opportunity that yielded about 10%, and then it's actually performed very, very well over the last few days. And so we're looking for lower risk cash opportunities. And so we had a great opportunity on a sell-put there where volatility was still high unnecessarily so. But stuff like that is what you might expect in the course member live streams. I'll link down below, or just go to meetkevin.com. Okay, so let's keep going here. The economy is showing early signs of improvement in Jan-Feb, including receding inflation, but slow and steady growth in GDP. We're always expecting more of a slowdown in 23 with tepid macro expectations. But 3 months later, we see economic signals, oh, wow, listen to this, are actually not so bad. And some of them are improved if we compare to 3 months ago. Wow. This is a phenomenal piece by the Wall Street Journal here. This is actually quite unexpected. I thought I had to hide in Trade Desk for my advertising exposure, but this is really suggesting that the advertising market is really still quite strong. You know, one of the companies that I keep referring to when it comes to advertising, a company that's just spending like crazy, is actually Carnival Cruise Lines. Oh, my hair is a little wild, isn't it? Isn't that beautiful, though? Don't you like it when my hair's crazy? That's because I'm crazy. See? I mean, who else would drink coffee out of a Don't Sue Me Bro mug? But I appreciate you saying that, One Positive Dude from Twitch. That's actually a perfect name. Appreciate you. But anyway, this is really incredible. So I was going to say, I don't remember what I was going to say. Let's keep going. Let's see here. Oh, yeah. Carnival Cruise Lines is advertising like crazy because they're only at 91% occupancy and they're like freaking out trying to get to more occupancy and they can't pull it off. So what are they doing? They're like tripling down on advertising. It's wild. Anyway, if it was 20 years ago in this economic climate, we'd probably expect advertising spending to fall, but we don't because there are organic growth factors to put against this macro environment that is uncertain indeed. The organic drivers that boosted the ad market in 2021 and the first half of 2022 are still around and mitigating the impact of stressful economic signals. Automotive ad spending is also expected to rebound in 2023, thanks to pent-up demand for auto marketing. Wow, this is actually really incredible. That's awesome. Okay, so great news for advertising. Let's go back, though, since this is really supposed to be about ChatGPT style stocks here. AI across its platform, particularly across core products at Microsoft. And here are some various products they have. Okay, fantastic. Microsoft is in a unique position to basically to augment human productivity. You know, I remember when I interviewed, it was a great in-person interview with Brett Whitten over at ARK Invest. he suggested that AI in the future will just be basically embedded right into our Google spreadsheets or our Microsoft Excel. And so we'll be able to tell AI, hey, and to some extent, you could already do this. Hey, I don't want to do all this work. Can you basically do this for me? And with the click of a button, it's done. I mean, I used to spend 8 to 10 hours a day building spreadsheets. And I'm really familiar with the efforts and tribulations that come with building spreadsheets. And golly, if AI could check your logic even, oh, it's great. And it's already doing that. I mean, you could go through some Twitter posts where people purposefully take code that they deleted some code from and they inject it into AI or the chat GPT-4 and they're like, hey, can you fact check this? And the AI is like, oh, it looks like, there's a section missing. This would actually work if you injected this piece of code in. And it has no idea what you deleted, but it basically finds exactly what the problem is in the code and adds it right back in for you. It's scary. It's like a self-healing robot. That actually kind of makes me think of video games, like when you shoot the alien and then they look down at their bullet wound and it just heals back up. It's like, is that all you got? Oh, two Transformers-ys. Anyway, oh man. Hey, this is the perfect spot to remind you to get life insurance in as little as 5 minutes because we have no idea when the robots are going to take over and kill us all. I think this is probably not the best way to advertise life insurance because it's a little bit gloomy and, hey, we got to put the paid promotion thing up here. But yeah, you could get it in as little as 5 minutes by going to metcavin.com/life. All right, here we go. So, all right. So Microsoft, fantastic. Prioritizing R&D. Okay, great. Alphabet. Going back 5 years ago, Google began a series of introduction outlining how AI would be the driving force behind many of the company's products, alongside a broader computing shift, including Google Assistant, Duplex, Lens, Translate, blah, 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 blah. We see the recent announcement of Bard as an extension of these efforts to match product iteration and continuing the evolution of search with recent customer excitement about ChatGPT, of course. Okay, great. So what are we going to do? What are their examples? They want to infuse all of its products with AI, such as Maps, YouTube's recommendation engine, autocomplete on Gmail. Autocomplete on Gmail is already pretty dang good. In addition, we see Google at the forefront of an AI-driven automation within digital advertising with Performance Max. It's automated end-to-end campaign management service that optimizes spend across inventory. Okay, now that's actually pretty brilliant. This potential that you could actually just have, and maybe they already have it based on this thing called Performance Max, you could potentially have an ad campaign, and then rather than you monitoring it or having someone else monitor it that you're paying for, you basically just have AI monitor your campaigns. Now, why is that important? Because when you spend money for ads, you end up as a business spending more money when the ads do well. So there's an incentive for the ads to do very well for everyone. Like Google wants your ads to succeed, right? Because then you'll spend more money. Well, what if your ad starts out doing really well and then people get numb to it? Well, maybe AI could kind of do that for you by transitioning some of the wording or changing it up a little bit. So quick little Google here on, Performance Max. So I'm like Googling about Google. That just seems monopolistic. But anyway, Performance Max is a new global-based campaign type that allows performance advertisers to access all of their Google Ads inventory from a single campaign designed to complement your keyword-based search campaigns to help you discover more converting customers across all channels. Performance Max helps you drive performance based on your goals. Performance Max combines Google's automation technologies across bidding, budget optimization, attribution, and more. See, that's actually pretty smart. That's fantastic. I mean, that's a game changer for advertising, honestly. That's really cool. Google's ads automation uses machine learning to grow your business. You can input your unique expertise, such as budget, business goals, and conversions you want to measure. Google Ads automation will find potential customers for your goals and serve the most appropriate ad with optimal bid and maximize campaign performance. I want to maximize performance. I love maximizing performance. All right. So that's cool. with internet coverage, Alphabet leading blah, 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 blah. Okay, that's just pitchy over here, multi-track record. Okay, whatever. NVIDIA, what do we have over here? We envision a whole host of semiconductor companies across compute, network, and memory landscape benefiting from the proliferation of AI. We continue to highlight NVIDIA, a stock recently upgraded to buy. I've got a big position in NVIDIA, so I feel biased reading this one, but whatever. To support the production and development of larger models, whether it be for major cloud hyperscalers or for enterprise customers. As we stated in our upgrade note here, we model an acceleration of the rate in NVIDIA's wallet share within the context of overall cloud CapEx as a growing percentage of data center compute. Okay, basically, stock go up is what they're trying to say here. Furthermore, to the extent there's any doubt related to the sustainability of NVIDIA's competitive position, we believe the acceleration in AI development will, if anything, serve to extend the company's leadership. Notice how they're not talking AMD over here. That's pretty incredible. That's awesome. Wow. While much of the focus around the theme of generative AI has been dominated by market share by search and gross margins, blah, 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 we believe enterprises push deeper into machine learning with companies like Amazon. Interesting. AWS is exposed to this theme in a number of ways through their AI machine learning services such as Amazon Lex, Polly, Transcribe, Comprehend, Kendra, Translate, SageMaker, among others. It's a good point. I mean, again, a lot of these platforms are hosted at a company like Google or Amazon, and then you basically let them do the compute for you. The same advertising benefit that Google saw could be talked about at Amazon as well. That's pretty incredible. Wow. All right. Salesforce. As part of Salesforce's path to unlocking value, we outline the view that the incorporation of generative AI have long-tail benefits for the companies for end user experience. Okay, I'm going to they announced Einstein GPT for sales and marketing and stuff. Something that's really cool about AI for sales is the potential to predict when you should actually reach out to your customer. Well, I think that's really, really cool. When I was a real estate agent, I'm still a real estate broker, but when I was actively selling real estate, I'd have my own customer resource manager that I built, which was pretty basic, but it was still awesome. It was perfect. And so I would look and go, oh, I haven't followed up with this client in X number of days. But one of the things that I was always frustrated by was I would look at the list and I would go, okay, even though I haven't followed up with this client at 45 days, I personally know that I shouldn't follow up with this client until 6 months from now. But I personally know I should follow up with this client not after 45 days, but after 10 days because they're very hot and the other person's very cold, but will be hot in the future. Anyway, that sort of thinking, I'm personally trying to predict. Well, a machine could probably do that a lot better than me. So it's very interesting. I kind of agree. That's actually very interesting from a customer resource manager point of view. AI could be a game changer for Salesforce. I hadn't even thought about that. But now that I'm putting myself in the shoes of a sales representative, hell yeah. Meta. We see Meta as okay. So I've had problems with mentally with Meta because they're so convinced on this like virtual reality and AI. Personally, I think virtual reality is like 20, 30 years away. I think augmented reality will be bitching. Like, I want to just put regular glasses on. Do I have any glasses here? I don't have any glasses here. I just want to put regular glasses on and be able to have like, I don't know, news feeds or like news alerts pop up on screen, kind of like imagine walking around while you're listening to a YouTube video and then all of a sudden a banner pops up that reminds you about courses and an ETF and a real estate startup and affiliate links. Yeah. Anyway, so okay, back so anyway, I don't like that they're spending all this money over there at Meta, but it's been a great place since their lows of about $80. I'll give them that. So anyway, what do we have over here? So they see 110 billion in CapEx, the majority of which is going to Meta's AI investments. With regard to generative AI specifically, Meta has launched a number of products, including Make a Scene and Make a Video, a text-to-image and text-to-video model to optimize blah 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 access to their artificial intelligence and API, whatever. Same thing with ad targeting. That's true. They'll have the benefit of ad targeting. Generative AI debates will likely persist for them. Yes, I agree. Reels. Okay, cool. Adobe. Though Adobe made its first announcement under the generative AI umbrella at its summit conference last week, we highlighted Adobe's early investments in AI machine learning tech, evidenced by the release of Sensei in 2016. So I wonder how they could do that. Like, I wonder if you could use AI to basically build an architectural rendering for you. That would be really cool if you were like an architect. And I don't know why I'm thinking AutoCAD right here, but AutoCAD is not Adobe. AutoCAD does a lot of architectural work, and I wonder if you could use AI over there to sort of generate models. Like if you could take a Matterport scan and then have AI do the actual like 2D plan for you appropriately and fact check it because there's some conversion problems from Matterport, that'd be pretty sick. Because now you're really taking the real world and able to manipulate it with generative AI. That's crazy. Anyway, Adobe would be more of your like After Effects or Photoshop or Lightroom. I mean, quite frankly, some of the AI that you could use now already with like Lightroom to automatically enhance your photos is really good. It's pretty incredible. ChatGPT was the fastest application to exceed 100 users. Pretty incredible. How does it work? Fine, whatever. I did want to also hit this story here. This is a financial. Remember how I was talking about how the Wall Street Journal was talking about basically jobs being affected? Financial Times takes it a step further and goes as many as 300 million jobs could be affected. And potentially how because AI is going to get so strong, we could actually end up seeing a significant disruption to the labor market, exposing 300 million full-time workers to automation. Lawyers and administrative staff would be among the greatest risk of becoming redundant. Wow, lawyers. I didn't even think about lawyers. I mean, I still think you need great people who can present a case, but if you can have AI do your case law searching for you and like go through these 5,000 cases and find me case law related to my case. Oh my God. Oh, that's a game changer because you have to like pay people lots of money right now to do research, or like when you do discovery, and you get a box of 5,000 pages of documents, scan it up and tell AI, find incriminating evidence, and then stitch a story together about how this person's a criminal or a fraud or whatever. Oh my God. That's crazy. I didn't even think about lawyers. I mean, I get it from the point of view of like document prep, but wow. To calculate that roughly 2/3 of jobs in the US and Europe are exposed to some degree of AI automation based on data and tasks typically performed in thousands of occupations. Most people would see less than half of their workload automated and probably see their jobs continue. Well, yeah, sure, because we've got a lot of workers around the world. But still, 300 million job losses, that'd be crazy. And that's just with what we know right now. We could see 63% of the US workforce affected, 30% unaffected, probably like honestly construction. Right? Like, I mean, you swinging a hammer, it's going to be a while before you get your Optimus bot to come swing your hammer for you. Wow. That's wild. Here's another one. AI develops cancer treatment in 30 days and predicts survival rate. New York Post. Oh, wow. Here's a use case to show the capability and complexity that AI can replace. Artificial intelligence just developed a treatment for cancer in just 30 days and can predict a patient's survival rate. A new study published in the Journal of Chemical Science. Researchers at the University of Toronto, along with In Silico Medicine, developed a potential treatment for some form of carcinoma. That's like a skin cancer, right? I don't know. Whatever. I'm not a doctor. A stock doctor. Where's my doctor thing? Anyway, with an AI drug discovery platform called Pharma AI. HCC is the most, it's a liver. See, that just tells you how wrong I was. HCC is the most common type of liver cancer that occurs when a tumor grows on the liver. Okay. AI-powered protein structure database from Pharma AI uncovered a novel target, a previously unknown treatment pathway for cancer, and developed a novel hit molecule that can bind to the target without aid. Dude, are you serious? Holy crap. That is absolutely incredible. Wow. That's really, really awesome. Any potential drug would need to go through clinical trials before widespread use. Yeah, but you know what we're going to get next? We're going to get AI clinical trials. Well, the AI took the drug and the AI survived. AI is rapidly changing the way drugs and medicine are discovered and developed from traditional methods of trial and error, which are slow and expensive, which limit the scope of expansion. AlphaFold broke new scientific ground in predicting the structure of proteins. Protein folding, by the way, is something I basically know nothing about. I am clearly an incompetent when it comes to protein folding. But apparently, when you're trying to do like genetic work, you're trying to predict how basically proteins in your body or in nature can be created. And we're really bad at doing that. But AI is apparently really good at doing that. So if you care about folding proteins, this is good. That's about as deep as I can go. I'm sorry. Like I will just be transparent with you. There's some things I just don't understand. Yeah, cool pictures, trials, medicines. Look at that. In vivo, in vitro, in life, in petri dish. See, look, I'm an expert. I know what I'm talking about. Anyway, this is really cool. Wait. In silico? Wait, what? What? Wait a sec. This is what I was joking about, discoveries, like doing clinical trials in chips and that. But that's kind of what they're talking about here. AI could be a cutting edge technology for future cancer care. Yeah. I mean, that's basically okay. Yeah, that's basically what they described earlier about being able to figure out a new potential cure for cancer. That's crazy. Really, really cool. So I have to say, AI, absolutely phenomenal. And if any of this makes you nervous, get life insurance in as little as 5 minutes. Make sure you check out the programs on Building Your Wealth link down below. We're starting again with our buy-sell alerts. We just did some awesome sell-put alerts for something that ended up playing out really well. I hope to have many more of those great plays. I look forward to also you getting yourself 12 free stocks at Webull. MattKevin.com/Webull. And go to househack.com if you're an accredited investor, because you got an expiration for that on the 31st. Now we got to talk about GDP and jobless claims that just came out. This data just came out. We got initial claims for jobless data coming in at 198,000 jobless claims. The expectation was 195. The more jobless claims we get, the more of a sign that maybe some of the impacts of higher rates are starting to hit. The last report was 191. We were expecting 195. We got 198. Continuing claims, unfortunately, though, well, I guess good for the individual, but not so great for necessarily the economy, came in low. The estimate was 1.7 mil. We came in at 1.689, suggesting people were able to get right back into the labor market. We did get GDP annualized quarter over quarter at 2.6%. Slightly lower than the survey and last read of 2.7%. We also got personal consumption, which has officially dropped. Last read, 1.4%. The current survey, 1.4%. Current result, 1%. So a miss on personal consumption. GDP price index, stable at 3.9%. That is consistent with the prior and the survey. Core PCE, quarter over quarter. That's the quarter measure of the personal consumption expenditure. That is not to be confused with the data that we get Friday morning on the 31st, which would be the month over month and year over year figures for PCE. Quarter over quarter PCE actually rose a little bit to 4.4%, up from the prior read of 4.3 and the survey of 4.3. So what do we make of this? Well, somewhat mixed data here. A little bit higher on the core inflation numbers here on the quarter over quarter. GDP a little slower than expected, and retail and personal consumption coming in slightly lower than expected. We don't necessarily like that, because what we want to do is avoid a recession while at the same time inflation comes down. We just got the opposite, right? We got a little bit more inflation and a little bit less GDP and a little bit less retail sales. So we actually went these numbers that just came out a little closer to recession, a little further away on the battle for ending inflation and the inflationary fears. So I would say not fantastic. I'd like to take a quick look to see how the market is responding to that. These are not horribly different, though, from expectations, so they're pretty close. And the market initially had a slight red candlestick on the NASDAQ. We slightly red candlesticked over to the, in this case, 200-minute moving average. However, we immediately green candlesticked right after that on the NASDAQ. So it looks like the market is willing to accept more patience here. The same thing happened over here on the 200-minute candle for the S&P 500. Another place that we can look will be the, let's look at yields. So let's see how yields are moving, specifically bonds. Looks like bonds basically flat on this news here. We've got the 10-year sitting at 3.572. If we compare this to the 2-year Treasury yield, we'll be able to look for an inversion of the yield curve. And remember, it's generally the subsequent re-steepening of the yield curve that is the most painful. 2-year sitting right now at 4.126, so still inverted on the 2s, 10s over here. And a lot of folks say that you get the inversion basically right when you hit recession. So something to keep in mind there. Let's take a look at what Wall Street is suggesting about this and potentially also CNBC. So let's give them a quick listen here, right here.
Today, Joe.
Yesterday and today. All right. How's the days in? Okay. You have any room service?
No, Joe, we're at a pretty decent hotel here. You know, we've been doing this for a while.
Why is it when you jump over to CNBC, sometimes they just talk about nonsense? Anyway, so no real comments from Wall Street just yet. Let's see if they actually have any from on CNBC here. Otherwise, I'll go to Bloomberg.
Why don't they show up in jobless claims? I think the story, Joe, that I came up with at the very beginning and seems to be the case right now is they seem to be getting jobs, or maybe it's just the extended benefits package makes them ineligible for jobless claims. But the idea that we're still under after how many weeks running now is really quite remarkable. You would have thought we would have had a surge yet. And it's interesting the Fed just can't get that job market to loosen up the way it wants to.
Give me I know there's going to be a first read on first quarter GDP. Give me your preliminary read on first quarter GDP.
Yeah, we're seeing like 2%, I think was the latest, Joe. In fact, I was just trying to look it up before because I was inside listening to Sheila Bair, but our CNBC rapid update. Yeah, former Chair Bair, who is really good. But the last I saw, Joe, was around 2%. So that recession that everybody thought was going to happen in the first quarter isn't going to happen, and I don't think they're predicting it for the second quarter. It's down the road someplace, and at some point, I guess it happens in the sense that you have these inventories pull back. But I was talking to somebody last night who said they have a lot of retail clients, and the retailers were preparing for this downturn. And of course, once you prepare for a downturn, sometimes that shock doesn't ever happen because you prepared for it.
You got a frog in your throat? You got a little froggy? Are you okay? You all right?
That's actually a fan. I don't know why they're so distracting. I think it's so interesting that I think fate loves irony. Elon Musk says that. I'm stealing a quote from him. And how crazy it would be if we don't actually get the recession. Like he just said, Leisman just said, we might not actually get the recession because people come to prepare for the recession. How weird is that? That would just be bizarre. That like, okay, all right, let's be a little more careful. Wait, let's not go to the moon here with our spending. Let's just be a little bit more relaxed and measured. And then what ends up happening? People are relaxed and measured. You get slightly above zero growth, but you don't get negative growth. And then what? you don't get recession. That would be wild. And see, I think there's a lot of talk right now that the way that we get lower prices will really be, like lower stock prices, the start of the recession. That's what a lot of people are predicting and projecting right now. It's worth looking at the 5-year break-even inflation rate, because the 5-year break-even inflation rate is moving up a little bit. And the moving up of the 5-year break-even inflation rate does potentially suggest the Fed's going to have to talk that down again and really push us into recession to actually get that inflation down. So we did have a softening there with the banking crisis of that 5-year break-even. But now as the banking crisis is fading, you're actually getting the 5-year break-even inflation rate kind of try to move back up. I'd like to see this trend continue. If I go ahead and draw a trend line here, let's see what we can draw. It's very difficult to kind of draw something solid here. Let's see if I maybe go from over here, maybe we could draw a trend right about here. We'd like to see this overall downtrend. Obviously, you know, in the big zoom out here, it is. But it's a little problematic that we had this spike over here. And that was before the banking crisis. So the only thing that really recently lowered these expectations for inflation were the banking crisis. So not fantastic. Let's listen into a reaction over here on the data.
Even if Silicon Valley had been in the stress test for real last year rather than their dress rehearsal, with the scenario, I think they would have come out just fine. But what does that point us to? That points us to the fact that the stress test has become a compliance exercise. It's become eminently predictable. And you know, Becky, I would be surprised if there hadn't been some voices in the Fed over the last several years saying we need to be testing for increased interest rates. But just as supervision generally, I think the stress test has just weakened over the years.
Yeah, and that's likely to continue to happen. You know, Joe Biden right now is talking about this idea of maybe punishing the mid-sized banks and the larger banks, but exempting smaller banks. Credit unions are banding together, blaming markets and saying, look, it's not fair to punish all the small banks because if we collapse, it's not a big deal. We're small. But then at what point are you systemically important? And that was supposed to be 250 mil, but apparently it was the smaller banks like Silicon Valley Bank or Signature or Silvergate that were important enough to basically bail out. So it's interesting. Regarding this data that just came out, we do have a comment here that, quote, data offers a little fresh insight. There isn't much new insight from this morning's data releases. Jobless claims were pretty much bang in line with expectations, while there were some modest downside adjustments to stale Q4 GDP figures, thanks to a downgrade of consumer spending estimates. Core inflation was revised slightly higher, but that's pretty much ancient history now. Tomorrow's February PCE data will be much more relevant for the near-term fortunes of the market. But arguably, even that data is stale after this month's turmoil. They basically just put salt on the PCE release tomorrow. Come on, man. That's not cool. I want to cover the PCE tomorrow because that way I can remind you about life insurance and free stocks linked down below and an ETF and course member live streams and my real estate startup. Whatever. It's actually an interesting point, though. I mean, could it be that inflation data from February is stale because of the banking crisis? I mean, I suppose. Do normal people spend less money because of the banking crisis? We know businesses do, but do regular people really care? I don't know. I suspect not. But that gives you the numbers that came out this morning, why the numbers from this morning could be a nothing burger, what they could potentially signal. I like Leisman's argument about, wow, it seems like the Fed just can't do anything to get jobs down because people are just finding new jobs. Kind of reiterates the idea of a tight labor market, I suppose. But at least you could still check out the links down below and support your favorite channel on YouTube. As always, appreciate you coming back and subscribing and sharing the videos. Try to provide the best value possible. Thanks so much. All righty then. GDP. Patty, that sounds awesome. Welcome aboard, Patty. Thanks for being a channel member. Shout out to all of you, by the way, as channel members. Appreciate you. AI boom might counter, question mark. I'm not exactly sure what you mean there. Might counter the inflation? Oh, maybe, yeah. People are freaking out over China-France LNG trade settled in yuan. You want me to tear that crap apart for you? I'll do that. I'll tear it apart. I'll tear that crap apart so fast. China, France. Stand by. I was reading about this yesterday. It's really not that big of a deal, but I will discuss it. All right. Stand by for the China discussion. Is that in here? Did I fix it? I have to make sure this is in here so I can actually not get interrupted while I'm in the middle of talking about it. Did I add it? Where is it? Where's it? Euro. Euro. I need the euro. Stand by for Kevin to get his act together. Okay, I got it. Oh, dear Lord. All right. Okie dokie. All right, let's talk about the PetroDollar and LNG. All right. Well, the world is freaking out over the idea that the US dollar supremacy is being faded away, that the US is going to get pushed into a corner and China is going to take over the world. After all, China not only just established a partnership with Saudi Arabia to start trading and settling oil in Chinese yuan, renminbi, instead of the US dollar, aka the petrodollar. The US currency is the world's reserve currency. Everybody buys oil in dollars, and therefore the dollar stays strong and America remains relevant until it's not. Like the Chinese partnership between Saudi Arabia and China to trade oil in Chinese money, and a now newly reported release of information via Reuters that now the Chinese national oil company CNOOK and France's Total Energies have completed China's first yuan-settled liquefied natural gas trade through not United States markets, but instead the Shanghai Petroleum and Natural Gas Exchange, according to the exchange on Tuesday. Approximately 65,000 tons of liquefied natural gas imported from the United Arab Emirates traded hands in this via the Chinese currency, not the American dollar. And this is leading a lot of folks to wonder, holy hell, is this the beginning of the end for America? Because as we've talked about over the last few days, we've made an End of America video discussing how our politics are becoming so divisive. People care less about their community, patriotism, and they care less about having children. The only thing people seem to care about that's been a change over time over the last 30 years is money. That is community, patriotism, children, all down in interest, but money up. At the same time, now we're seeing the petrodollar be faded away, while we also talked yesterday about the weakening of America's military in the Middle East, how we're potentially becoming irrelevant in the Middle East, that out of 78 times Americans were attacked in the Middle East since we withdrew from Afghanistan, the United States military has only responded 3 times. That's it. That's embarrassing, leading to more and more attacks because militants in the Middle East just don't care, because why would they if they have basically a 5% chance of actually getting attacked back? It's pretty embarrassing. So it's leading a lot of folks to really be concerned about the petrodollar and the potential that the United States will lose its status as the world's reserve currency. What could that do to America? Well, it could be bad. If the dollar becomes less relevant, then other countries will be less likely to want to hold treasuries. When other countries hold treasuries, they actually lower borrowing costs in America because they lower rates. They make it cheaper for us to do business. They make it cheaper for our government to finance policies, whether it's stimmy checks or new parks in your neighborhood. They keep our car rates down, our credit card rates down, our mortgage rates down. They make it easier for us to trade with foreign countries. They make it easier for us to travel to foreign countries and spend money more easily. The US dollar is also a powerful tool for military efforts throughout the world. People want to be nice to America because we got the dollars. We got power, sanctions power, international power. We got power everywhere. So what is the petrodollar? Well, the petrodollar is just basically a fancy way of saying any dollars that are used for the trade of oil. And the petrodollar is really important because I want you to know the reality of what's going on here. And that's always what I try to accomplish on my channel. Obviously, I'm a licensed financial advisor. I don't give you personalized financial advice, but I give financial advice. I run an ETF. I have courses on building your wealth. I have a real estate startup. I have affiliate links for life insurance and some free stocks linked down below. You already know that. But let me give you my POV on the petrodollar. So first, some background. In 1973, the United States made a deal with Saudi Arabia that all oil sold by OPEC, that is sort of your organization of petroleum exporting countries, mostly in the Middle East and Africa, all of that oil would be priced in US dollars. And in exchange, the US promised to protect Saudi Arabian oil fields from attacks. So think about it. We'll send our guns, you trade oil in dollars. This deal created the petrodollar system. It made and it helped make and maintain the US dollar as the world's reserve currency. And it allowed the US to, guess what? Print more money without causing inflation. Because the more people use the dollar, the more people trust the dollar, even though we're inflating the crap out of it. The petrodollar also gave the US enormous economic and geopolitical power as countries around the world, as I've mentioned, needed to hold dollars to buy oil. And every country needs oil. Losing the petrodollar would be an incredible hit to the strength of the dollar. And it could make products substantially more expensive around the world, causing something known as imported inflation. So in addition to rates going up, like I've just talked about, you could also see imported inflation. Imported inflation is the last thing we want. Higher inflation would mean more financial strife in America. So that would be very bad. Now, keep in mind, the easy way to think about a strong dollar right now is think about an iPad. If an iPad sells for 700 euros in France, that iPad sends basically $820 of US dollars back to America. But what if the dollar is super, super strong? Well, that weakens money that we get from other countries, right? When the dollar was actually stronger than the euro, we get less dollars back. So it hurts companies that actually sell stuff in other countries and send the money back. But for us as buyers, we love it. Because if I could go buy a 700 euro iPad and it only cost me $680 versus $820, I save money as an individual, right? So that just gives you another example. So the strong dollar helps individuals and people who sell stuff in America. But in recent years, there's been a big push to create an alternative to the petrodollar system. And this is sort of especially now because of these deals between China and other countries. And a lot of it has started because we kicked Russia out of the SWIFT system. Now, SWIFT is the Society for World Bank Interbank Finance and Telecommunications. It's basically a communications tool for transferring money between different countries. The U.S. has used SWIFT to enforce sanctions against other countries like Iran and North Korea. But China is like, we don't know if we want America to have this much power. So China created CIPS, which is the China International Payment System, as an alternative. And so they're really trying to hit us on both ends. Not only are they trying to get rid of the petrodollar and use the yuan dollar, but they're also trying to get rid of our banking communication system as China tries to be as their premier, who actually just spoke yesterday, says, a world force for stability. So they're trying to basically eliminate America's power. This is how the end of America begins. Now, When we talk about the petrodollar, it's important to remember that OPEC controls about 40% of the world's oil supply. And right now they use the dollar. So that's a big part of the oil supply that uses the dollar. And we've been using the petrodollar system since really, like I mentioned, the early 70s. And the way to think about the petrodollar, I think, is in comparison to other uses of dollars around the world. There's something known as the eurodollar. The eurodollar is kind of like a petrodollar. It's not a euro, not to be confused at all with the euro. It's basically just dollars held by other countries outside of the United States or even within the United States at embassies. And what I like to do is I like to compare the petrodollar's strength to the strength of the eurodollar to show you how much you should actually be concerned about the loss of the petrodollar. So here's the way to look at it. The petrodollar trades by the amount of about $3.5 trillion per year. This is the petrodollar right here. Okay. The eurodollar system trades to the tune of about $12.4 trillion. I'm going to call it the E-dollar, not to confuse people with the euro because it's still the US dollar. So the petrodollar is actually about 1/4 as important as other countries using dollars to buy treasuries and have dollars in their reserves outside of the petrodollar. So as scary as it initially seems that we might lose the petrodollar, when we actually look at the volume of trade in the petrodollar system, it's significantly smaller than the dollar's strength outside of the oil and natural gas sector. So as nice as it would be to maintain the petrodollar, some losing of the petrodollar strength to China probably isn't as big of a deal as it seems. Now, other countries in the past have tried to de-dollarize. Venezuela in the 90s and again in 2017 tried to de-dollarize. And what did the U.S. do? The U.S. basically imposed massive sanctions on Venezuela and helped them create a massive distrust for Venezuela's own currency, which led to inflation in Venezuela that was 1,000,000% in 2018. And it fell all the way to 19,000% in 2020. Venezuela had so much inflation after trying to get away from the petrodollar system that they actually tried to create a crypto called the Petro, which the US basically called a scam. So it's obvious, like trying to get away from the dollar system has been tried before, but it's actually surprisingly sticky. And even if we lost the petrodollar, it's a drop in the bucket relative to E-dollars. I'll call them E-dollars, not to confuse them with euros. So the point is, losing the petrodollar probably isn't that big of a deal. And it's actually really, really sticky. Just because we hear of some of these trades outside of the petrodollar system, we've literally been hearing about that for decades. But here's how I really want you to put to rest the FUD around losing the petrodollar. You ready for this? This is my take on how you get rid of the FUD for losing the petrodollar. Other countries have been trying to get out of the petrodollar for 30 years. Even if we lost 100% of the petrodollar today, it wouldn't be that big of a deal. Even though there are fears it would be, when we look at it actually as sort of along like the global banking system scale, it's a drop in the bucket. Petrodollar, 3.5 trillion, the global banking system's like over $100 trillion. Like it's not that big of a deal. But anyway, even if we lost 100% today, it's not a big deal. But we're not going to lose 100% today. It's going to probably take 30 years, in my opinion, to actually kill the petrodollar. What do you think is going to be less relevant in 30 years? Oil. I hate to say it, but as the petrodollar, which is, let's say, supremely relevant right here, as the petrodollar, that might be 2008 where it was most relevant. As the petrodollar loses relevance, and maybe it's totally gone, the petrodollar dominance is totally gone in, I don't know, 2055. Let's just make that example. What's going to happen between now and then? Well, petro, aka oil, isn't going to be relevant anymore anyway. Instead, we'll probably be a lot more focused on like the N-phase dollar, who controls the microinverters for solar, or the EV dollar, or some form of other, or the self-driving and autonomy dollar, or the AI dollar. So really, this fear around the petrodollar and the Chinese working with the French and the Chinese working with Saudi Arabia. Yes, to some degree, it's a sign that oil or America is losing relevance. Yes, to some degree, it's a sign that America and American exceptionalism is being worn away. Our exceptionalism is wearing away. There's no question about that. Is this something that is going to change tomorrow and cause massive issues? No. Is this something that China would love to go away? Of course. I mean, keep in mind what helped create and prop up the petrodollar system. Nothing other than the military-industrial complex. The U.S. spends more on its military than the next 10 countries combined. The military-industrial complex has a vested interest in keeping the dollar strong. That makes a lot of sense. And so, of course, a country like China wants to slowly start mining away the importance of the US dollar. But even though we might not trust currencies and trust fiat, there is no currency that is trusted more than the American dollar. And you could see that just by comparing the e-dollar space, euro-dollar space, relative being 3 times the size of the petrodollar space. And how important is the petrodollar really in the grand scheme of things? I mean, yeah, it's useful. Maybe it provides some form of global stability, at least at this point. But by the time it actually matters, I don't think oil will matter anymore. So do I really care? Bottom line of all of it. Do I really care that China is, playing, with liquefied natural gas with France? No. So the next time somebody asks me about the petrodollar or asks you about the petrodollar, make sure to send them to this particular video, because I think we provide a realistic perspective on how the reality is this isn't going to affect your daily life. There's a lot of FUD around what it could do. The reality is it's going to be such a slow burning candle, it probably won't matter. But if for some reason it still gives you anxiety, get life insurance in as little as 5 minutes by going to metkevin.com/life. That is a paid promotion. Make sure to also go to metkevin.com/free to get 12 free stocks via Webull and check out the programs I'm building around. All right, that was fun. All right. Next story. What is next? Oh, yeah, we got to do our daily dose of FUD. Yeah. Wow, we got a lot to cover. All right. Let's do... This is actually a really good piece. I don't even know if I want to share it with y'all because it's so good. I'm just kidding. Of course I do. Oh, but first we have to do Nancy Pelosi's trades really quick. We could do like a little short segment on this. How do we want to do this? Let's see here. Yeah, that would be kind of cool. All right. Oh, wow. So many. I'm going to add this up really quick. That's crazy. That's a lot. Hold on. Let's listen to Jimbo for just a moment, and then I'm going to cover a couple things.
Now, second best month of the year.
It's not supposed to happen, Carl.
Does it broaden out, or can you live with this kind of narrow tech?
I think that everybody is shoot first, ask questions later, except for these guys, because we don't know. I mean, I had Paychex home last night. They had a remarkable quarter. They do small, medium-sized business. They handle the payroll. And they were talking about how if you have more than $250,000 in one bank, you can't keep all your eggs in one basket. Now, they do like small law firms, accounting firms. And you say, well, someone is being hurt by that. Like, who is being hurt by that money coming out from a bank? Well, I'll tell you who's not being hurt. Apple. I mean, so you by default, you go back. And the one that has just shined here is NVIDIA. It's just over and over and over. You see, I'm watching Frank Holland this morning. and Nvidia's up 38 cents, and then it's up like 62 cents. Next thing you know, Nvidia's up like $1.08. And what's happened during that period? Nothing. I mean, oh, there it is, up 260. I mean, nothing's happening in Nvidia today.
Well, I mean, incrementally, let's take Intel, for example, yesterday.
Oh, that's classic.
Best day since November 10th.
Yeah.
I mean, the webinar could have gone worse, right?
Well, I mean, what were the notes about Intel? Okay, it's not as bad as it was. Maybe a little better than we thought. Well, I mean, and then AMD goes up because Intel's not as bad as it was. We're in. Yeah, I was saying to Ben Stoddard, who works with me for Mad Money, I said, in 2 weeks, we are going to have 35 companies we're looking at. We're trying to make a decision. Right now, we're looking at Cintas and a couple of layoffs at Warner Music. And we don't want to draw any huge conclusions for now, other than the fact that we know we're safe if we go into Microsoft. We just know it because there's no hair on the Microsoft story at this very moment.
Right. So that's a good point. We're 2 weeks out roughly from the bank earnings beginning on the 14th. Barclays last night says, we think this initial wave of deposit outflows is nearly over, but they think there's what they call a sleepy depositor that is kind of waking up to, hey, wait a minute, I haven't made any moves and maybe I should.
Yeah, that's what Paychex was saying, which is that if you call them and you're one of their customers, they have hundreds of thousands of customers to say, where's your $700,000? Well, it's with.
All right. And I saw that sleepy depositor piece too. I might talk about it in a few minutes. We'll see. But first, Nancy Pelosi. Okay. All right. Ready for this? Here we go. Nancy Pelosi is back at it again, except this time she filed a disclosure showing she lost $2.58 million on stocks that she just sold. That's right, over $2.5 million sold. What did she sell? Well, she lost about $11,000 on Alliance Bernstein. She sold $300,000 or 300,000 shares. That's 30,000. Dang it, I screwed it up. Why did I write that? I wrote it so stupidly. My bad. I have to redo that part. Sorry. I'll redo that part. Nancy Pelosi. All right. Let me do that one more time. All right. Nancy Pelosi is back at it again. She just disclosed that she lost $2.584 million on stocks she sold. And I'm going to tell you when and why she probably sold those. But first, where did she lose money and what did she sell? She lost $11,500 on Alliance Bernstein stock, $130,000 on Netflix, $850,000 on PayPal, $235,000 on Roblox, $733,000 on Salesforce, $511,000 on Tesla, $114,000 on Disney, and she didn't disclose a loss on Google stock, but also sold 30,000 shares of Google stock. A lot of people are saying, oh my gosh, this is a red flag that the economy is about to come crashing down. Methinks not. I actually think Nancy Pelosi and her husband have been doing so well with trades in 2022. This was probably a way to tax loss harvest, since this notification that we just got here in March, at the end of March, was actually for trades from December 28th, 2022. Looks like some tax loss harvesting to lower the taxes they pay to contribute to our American society, the one they want to keep spending money on. Cool. There's our Nancy Pelosi one. All right. Next up, we have, let's do the bear piece. Bear piece. Somebody says I need some stevia. Oh. Yeah. First time I've seen Kevin restart. Yeah. Sometimes you got to reboot the programming a little bit, Oh, dear Lord. All right. Let's do Tia Salambad. Oh, yeah. This is such a bear piece. Yeah. Okay. There are two pieces in this. All right. A bear piece. Well, y'all know that I'm a bull, but I love talking about the bear case because I want to see what evidence the bears have to actually be those dirty, lonely bears that they are. Just kidding. I still love you. No, I don't. No, we could still have a beer. No, we can't. I just changed that. Although I might flip-flop. No, maybe I won't. Anyway, let's actually talk about this piece out from T.S. Lombard, which just came out on looking for the next weakness. You know, why is it that it seems the bears keep having to come out with new excuses for why the market's going lower than it did in October? It's almost like they're running out of reasons. But you know what? They're still bearish, and I'm still going to cover it because I want to see, am I missing something? Because I'll tell you, the day I see something that scares me, I'll have to weenie baby and sell everything. Just kidding. It usually takes me at least a few weeks before I flip-flop. But anyway, financial sector cracks spread to the economy. Tightening is likely to be stronger and more unpredictable. The risks we know are less worrying. Now, that's interesting because usually these folks are very bearish, right? And I actually wrote that little note over here. I'm like, that's odd. They're usually very bearish. Don't worry, they get bearish. So, first, regarding the banking risk, their chief economist at T.S. Lombard has a house view, which is that the main takeaway of the banking turmoil is that we're likely to see a credit crunch rather than more bank failures. And while there are other risks out there, the broad conclusion is that a credit crunch will feed through into the weaker real economic performance, which in turn could touch off further financial disturbances and thereby compound. The most likely candidates emanate from China and more broadly, commercial real estate. Okay, quick note on China because everybody keeps talking about how China is going to go back and boom. Yesterday, Bloomberg did this live a blog on the Chinese premier's piece. The Chinese premier was saying the world is at a crossroads. Now, what I thought was really interesting is throughout this piece, the premier talks about how China is booming. And like their recovery is so stable and so much better than the United States' recovery. Well, what do you have over here? I thought this was like the best line ever. Li used Hainan's allegedly resurgence in tourism, in the tourism industry, as an example of China's rebounding economy. While I generally agree with Li, says the reporter, that things on the ground here in China are good, I can say, as someone who's been booking hotel rooms, there are a lot of vacant rooms. I read that and I'm like, of course. China is probably blowing smoke. They're probably doing a lot worse than they are actually letting on. They did the same thing with COVID. Why would they do anything different for the recovery? So of course the recovery is probably not as strong as this. This is why I have such problem trusting China. And don't get me wrong, I don't trust our government either, but I trust our government more than I trust China. And that's saying something. But anyway, going to this T.S. Lombard bear piece. So China and commercial real estate, the potential targets for real pain. Okay, tightening is likely to be stronger and more unpredictable. Okay, so let's learn a little bit why. The hard landing risks have clearly risen. Why? The economy needed something to slow down growth and thus inflation. But the problem with tightening lending comes from a credit squeeze that is unpredictable. The FOMC, the Fed, is unsure how much tightening has occurred. And notable hawks like Neil Kashkari are getting understandably worried. The curve is strongly signaling a recession. And after the curve reinverts, we tend to signal a recession has begun. And markets, therefore, are remaining on edge. But what's most important? Well, what's most important, says T.S. Lombard, is this: shaken confidence in the economy. Has this banking crisis now affected people's willingness to spend? Recessions can become self-fulfilling, they say. They say headlines of doom and gloom and recession and forecasts can negatively impact the investor, the consumer, and corporate behavior, feeding negatively into GDP. Though the the bulls on the flip side argue that, well, maybe we're so prepared for a recession that a recession won't actually happen because we hit the brakes on our spending to allow us to spend less so we don't have as bubbly of a GDP, but we can actually spread out how long we could survive the fight against inflation. Think about that graphically for a moment because I think it's interesting to potentially consider. So the bears say, okay, if that's recession, so let's draw that straight. If that's recession right here, In other words, that's the zero line right here. That's recession. Well, the bulls make the argument that, hey, look, GDP is doing so well. Uh-oh, recession's coming. Hey, let's moderate our spend and basically have the economy do this sort of like U-shape, right? Well, the bears say, no, you're going to have a recession. People are blind to the recession until all of a sudden they're not, like a financial crisis. And then maybe you get something like that, right? And this is recessionary, whereas this is not. It's an idea. So anyway, as our chief economist argues, jobs and income expectations have never returned to pre-COVID levels, meaning the damage to spending will be larger. Now, I have a counter to that, but let me make their argument first. Okay, so here's another T.S. Lombard piece, which actually goes into the details they're talking about here. Basically, what they're saying is consumer confidence and consumer expectations of the economy have never actually gone back to the levels where they were. See, here's a sentiment chart, and they do have a very interesting chart here. They make the argument that when the Fed cuts rates, which is signified by this light blue line here, when the Fed cuts, you see sentiment plummet. Here's a cut, sentiment plummets. Here's a plummet in sentiment. Oh, look, cut in rates. Here's a cut in rates. Oh, look, plummet in sentiment. And look at this downtrend on sentiment on the right. Sentiment never recovered to 2022. Now, I have a couple counter arguments to this, but let me just first finish their argument. Their argument is because sentiment is lower today, in fact, right now we're sitting at like 2007 levels. Basically, this next recession is going to suck even worse because we're going into it with worse sentiment. Okay, well, now it's important to know the following. I think that's really important. And this is my counter, and then I'll keep going with their bear piece, okay? So my counter is the following. It's two-folded, okay? So number one counter and then number two counter, okay? I'll put my little reminder right there. So number one counter I wrote, not necessarily. If the Fed is cutting rates because inflation is conquered, expectations, in my opinion, could ironically rise. The reason for that, and I give an analogy, it's like being on a ship. If you're on a ship that crashes into an iceberg, you might be like, oh my God, we're cutting rates because we just hit an iceberg. Oh crap, we might die. But if you were on a ship for a year, and at the beginning of the cruise, they're like, hey, by the way, we're fighting icebergs and really high inflation. And then all of a sudden you see land and you're like, oh, the inflation's going away. The signal is, oh, it's clearing up. The signal is actually positive. In my opinion, your expectations actually go up, not down. Because in my opinion, in this rate cutting cycle, when the rate cuts happen, you're sending the signal that inflation is conquered. I don't believe the Fed will cut rates until inflation is conquered. They will shove our faces into the mud of a recession before they cut rates and inflation is still high. They will not let inflation unanchor. They will keep rates high until inflation is gone. That's why, in my opinion, when the Fed starts cutting here, it's a signal. It's a bat signal going, inflation's over. Yay. That would be great. Very good. It's like seeing land and you have scurvy. You have scurvy and you're like, I need an orange. It's a good thing. It should increase your optimism, not decrease your optimism. The second thing that is a counter to this bear piece is they argue that, hey, but sentiment hasn't risen. Who cares if sentiment hasn't risen? You know what's risen? Cash. The amount of money people have, folks. The amount of people, the amount of money people got in their pockets, in their bank accounts. They got more money than they did in 2019. People have more money today than they had. Oh, look at this. There's literally a story on this right now. Rate hikes until inflation is killed, then return to normal. Let's listen to this guy for a sec.
No more runs on banks. Powell let it take the interest rates to wherever he has to take them to kill inflation. And then we can get back to normal.
Yeah. Dude, I swear, that guy was probably listening to my stream, and then he's like, let me call into CNBC really quick and basically just say what Kevin was just saying. This is fantastic. I mean, obviously, everybody subscribes to the Meet Kevin report. Yeah, that's a perfect opportunity to remind you to get life insurance in as little as 5 minutes, link down below. To make sure you check out the courses on building your wealth, link down below. Learn more about my ETF by going over to meetkevin.com and my courses, my live streams, my real estate startup, all that good stuff. Anyway, where were we before I went down this conceited rabbit hole that everybody obviously listens to Meet Kevin, hashtag don't sue me, bro. Let's go back to being humble. Where is that? Oh, I can't find it. Okay, so okay. So T.S. Lombard makes the argument that the coming recession is going to hit with overall sentiment and job and income expectations below COVID levels, pre-COVID levels. People did not buy into the post-COVID rebound, meaning other than backing and filling to a return to whatever. In other words, when the recession hits, the damage to spending may be a lot more than most of us expect and turn the recession into a deeper one than anticipated. There is still a strong contingent believing no recession at all, but there were a lot of very smart people in 2008 and in the spring of 08 who were arguing no recession was underway. That is true. There were a lot of people in like 2005, 6, and 7 that are like, oh, real estate's just going to level out. It's not going to crash. Don't worry. Oops. So I don't know. I mean, I have my bets placed. But anyway, so they talk about being short and underweight real estate. Mr. Schiller actually came out with a piece yesterday. He was shilling on basically how he thinks real estate's going to be in a much better position to buy in 6 months. And I'm like, wow, even a Yale economist, Mr. Robert Schiller, the founder of the Case-Shiller Index, watches the Meet Kevin report. Because obviously, if house hikes buying in Q3, Q4, we got to reiterate that. It's true. He actually said that yesterday. It's really interesting. I don't actually think these people watch the Meet Kevin report. Maybe they should. But yeah, I think that's very interesting. So, okay, so the bear piece is clearly established here that these expectations could potentially lead to a worse recession. It's an argument. Personally, I kind of think the bears are like grasping at straws at this point. You know what to me signaled that the Bears had kind of lost the plot? It was when Morgan Stanley and Mike Wilson, I have it right here, had this piece. This, to me, is when I thought the Bears lost the plot. You ready for this? The perfect analogy for where equity investors find themselves today, and quite frankly, where they've been many times over the past decade, more specifically either by choice or out of necessity, as stock investors follow prices to dizzying heights once again, is liquidity, just like bottled oxygen, that allows them to climb into a region where they know they shouldn't go and cannot live very long. They climb into the pursuit of the ultimate topping out of greed, assuming they will be able to descend without catastrophic consequences. But oxygen eventually runs out for those who ignore the risk. Because after all, there is a peak 3,000 feet above what is known as the start of the death zone at Mount Everest. And basically, stock investors are being morons who are going into thin air, expecting not to survive. Yeah, good one, Morgan Stanley from February 19th. Can somebody please send Mike Wilson an email and tell him to watch the Meet Kevin report and stop being such a bear? I would love to talk to Mike Wilson about PP together. Pricing power. But anyway, I hope I didn't just get the guy in trouble. I actually like his perspectives. I think he has, we cover him very regularly on here. He gets a lot of coverage. And I like understanding and viewing his bear point. I actually do agree that the S&P 500 is probably going to go down substantially. But that's why I'm ignoring the staples within it. But then again, Morgan Stanley's Mike Wilson's going into the staples, like Walmart. I mean, yesterday we were tearing apart Walmart and Colgate, Palmolive. Come on, Mike. Mike, we need to have a beer and we need to talk about this. And I haven't had alcohol for like 12 days. So that's saying something. I mean, I'm basically sober. With that said, it's important to remind you to check out the programs on Building Your Wealth link down below. Make sure you get your life insurance in as little as 5 minutes by going to metkevin.com/life. Not only go to metkevin.com/life to sign up in as little as 5 minutes. I went through the prompts yesterday. It is literally as little as 5 minutes. I personally use that life insurance policy. It's great. But also check out the courses on building your wealth, link down below, for our private course member live stream, the next of which starts soon. Love to see you there. You get my buy-sell alerts as well, specifically where we sell puts and calls. All right. Out of respect for the members here in the channel, does anybody have any questions? Let's do just a couple questions here. A little bit of a Q&A. When I asked my Morgan Stanley advisor what they're going to buy, they simply forwarded me a video of Mike Wilson. Dude, no way. Come on, man. The financial industry is rigged. Nobody has their own opinions anymore. Oh, it's embarrassing. Ed Sheeran's songs are being ripped off. Well, that's a bummer. All in on VOO. That's their total stock market, right? VOO. Oh, no, that's the S&P. No! No! I don't use Vanguard funds, so I don't even really know the tickers that well. QQQM, if you're going to do an index fund, in my opinion. QQQM. I need to make another cup of coffee and then go to the course member live stream. But I think we covered a lot today. That was fun. I hope you all enjoyed it. I enjoyed it. Big B? The heck? Oh, VTI is the total. Okay. I don't pay attention to that. Did you add moderators yesterday? We added a ton yesterday. We should have replied to you. If I put in Big B, I get Big Bear Mountain Resort. Dude, that looks fun. Oh, so many ski resorts got dumped on. Round Hill Big Bank ETF. I actually think there's a good chance the banks will actually recover pretty nicely. I pulled $40,000 from the S&P 500 to invest it in a 2.5% interest savings. Was that the move? Big opportunity cost in that if the market keeps going up, right? For a worker who saved up $65K, was planning to buy a house but live in a little owned apartment and thinks it's okay for now, keep cash in 4% savings account. So scary to see hard-earned cash get eaten by inflation. I mean, it depends what your income is, right? I'm a big fan of trying to get into real estate. So like, as long as you're like planning on investing, I think investing is much more applicable or important right now in these scary times than just trying to focus on like protecting yourself from inflation. I wouldn't worry about inflation. Inflation only matters if the stuff that you're buying goes up. If you're buying investments, inflation is great because inflation reduces asset prices. Like people are like, but Kevin, isn't your cash going down in value? No, it's not. My cash at, for example, my real estate startup, we got over $20 million in treasuries. And forget about the yield on it. It could just be in straight up cash. That cash value is going up with inflation. Why? Because we're going to buy real estate with it. And real estate prices are coming down, so I can buy more real estate with the same amount of cash. Now, if I took that money and I was buying oil or food, yeah, the inflation would impact me. But it doesn't, you know? So it's fantastic. So with that said, thank you so much for being here. I'm going to the course member live stream right after I pour a cup of coffee. See you soon. Bye.